Good morning, everyone, and welcome to today's webinar. My name is David Huxley from iCare's mobile engagement team, come to you from the far north coast of New South Wales, where I live. I'm on Bundjalung country. I'd like to pay my respects to elders, people, and ancestors of this country where I am based. I'd also like to pay my respects to the traditional custodians on the various lands in which we all work and meet today, and any Aboriginal or Torres Strait Islander people participating in this webinar. Welcome to this morning's webinar, which is specifically for New South Wales Experience Rated employers, which is an employer whose premium is greater than $30,000. Today, we'll run you through some of the basics about how your premium is calculated, including how a claim can impact on the premium charged. We'll discuss grouping, what that means, look at different categories of workers, and talk through the wage declaration process, as well as discuss a few recent changes that have been brought in and hopefully bust a few myths. Now, joining me today is Mr. Craig McBride. Craig joined iCare in 2017 and is the manager of premium services dealing with premium calculations and reviewing the premium model for the nominal insurer. Craig's been around quite a long time in the New South Wales scheme. In fact, since 1993, working across a number of different roles from policy to claims and managing the fraud and premium compliance unit. Good morning, Craig. Thanks for joining me again.
Thanks, Hux. All good. How are you?
Yeah, I'm not too bad. I'm getting through it. So, look, I'll just quickly call out, Craig, that today's session, we're talking about the conventional premium model only, not the loss prevention recovery model or LPR model, which is a different method of premium calculation for only a handful of larger employers. And if you are an LPR customer or you want to talk about the LPR model, we do have a dedicated team at iCare in the policy space that can answer your questions. All right, well, let's get into it now, mate. So let's start with one of the most common questions that we get quite a bit, which is how is the workers' compensation industry rates, or WICs as we refer to them, how are they set?
Every year, we submit a price filing to CIRA which details how we're going to calculate premiums and what rates we will charge for every year, starting from 30 June going onwards. So the scheme's constantly monitored by our actuaries and our external actuary affinity, and they look at the scheme valuation and see how it's performing. So for each week, and we have about 530 odd, we look at the last 5 years of history for them. So that includes the last 5 years of wages that they've paid, the last 5 years of claims costs and claims that we've had, and the premiums that we've collected to cover the cost of those claims costs. So it's basically an assessment to see if the premium rate that we're charging for that week as a percentage of the wages for everybody in that week is covering the cost of those claims and the other incidental costs that we have. So it's just like for the plumbing week, every plumber, we look at all of their wages, all of their claims, all of their premiums, and see, does the rate need to go up, need to go down, or does it stay the same to cover the cost of those employees in that week. And we do that for each week that we have, the 530 odd weeks that we have.
So, Craig, with that example of a plumber that you've just used, if I was a plumber here in northern New South Wales, I'd be charged the same rate regardless of location or size to any other plumber in, say, Wagga Wagga or on the Central Coast or Bondi or anywhere else in New South Wales. Is that right?
That's correct. Yeah, the same base rate applies to everybody in that industry to do the first part of the premium calculation.
Okay, and would I be correct in saying that the performance of a single employer in a category indirectly impacts the overall rate charged to all employers in the same category?
Yep. So all those claims that are incurred against employers within that week, and all those policies that we have, at every year when we assess the week rates, we look at those 5 years of claims made by all those employees in that classification to determine what rate we should set it at.
Right, well, so how exactly do we rate a business? I mean, many businesses have staff performing all different roles and different activities, and some of these would vary in terms of different risks. And for example, a small mechanic workshop, well, they're going to have mechanics on the tools repairing vehicles, and they might have admin staff in an office taking bookings and payments and that type of thing. What do we apply a different rate to the administration staff and the mechanics?
No. Since 1987, we've been an industry-based classification scheme. So the classification that will be applied to your policy is the industry description or the description of your business that best fits the overall business. So if you're a mechanic, you're a mechanical workshop, that's the WIC that you will get. And that includes all the people that work for you, whether they be the mechanics working with cars, or whether the person at the front desk issuing bills, receiving bills, making bookings. Even though they're not working in the operational area, that rate is applied to all wages paid for those, everybody that's employed in that mechanical workshop. Or if you're in a manufacturing business, whatever it is you're manufacturing, the relevant WIC for that applies to all wages that works in your business, whether they be clerical or admin staff, sales and marketing, or head office activities, or warehousing associated with that. They're all incidental activities to the running of that business, and that business is a mechanical workshop. Yeah.
And you can see that in that example of a warehouse or manufacturing environment on the screen there. We've got a couple of different pictures coming from the one business. Let's say they manufacture plastic items, plastic goods. We've got admin staff there, warehouse staff, packing boxes, cleaners, and people on the floor, the factory floor in the industrial setting. So when we go to rate this business, we'd look at the overall industrial activity, which is the manufacture of plastic goods, whatever that might be. And I'll also add that the WIC rates are constantly reviewed each and every year and do account for any emerging industries. And one example might be Uber. I mean, rideshare wasn't around, 15 years ago, say. So we have to account for that as new emerging industries come along. All right, Craig. So what if I experience a claim in my workplace? How will this impact on my premium?
Well, as for the employers that we've got here in this presentation today for experience adjusted, so there's two parts to your calculation. Once your average performance premium, which is your wages times your industry classification rate, is above 30,000, that sets the base premium. And then from that, we look at your own individual claims performance over the last 3 years to see whether you're performing better than the scheme average or the scheme performance measure, or worse. And if you're worse, you'll pay more than your base premium that's calculated, wages times WIC. If you're performing better, you'll pay less than that premium. So it's assessed based on your own individual performance once you get above $30,000 in APP, as to whether you're better than the scheme or worse than the scheme.
All right, and what we'll do now is we'll run through an example for everyone of that, how that actually works in reality, in the premium. And I'll kick off with the first part here, Craig. And we can see it can be quite tricky. So we're going to break it down into different components here. So the first part, which we've kind of already referenced, which is to calculate the average performance premium, which is quite similar to wages paid to staff multiplied against the WIC rate. Now, in the example on the screen there, the wages for this business is about $2 million, just approximately, multiplied by the industry rate for this business of 2.5%. So the average performance premium is $50,000. Now, what we do is we look at the next part of the calculation is to look at the employer's performance. And we do that by looking at the previous 3 years claims and the previous 3 years average performance premium paid. So by way of example, we're just going to use $3,000 per year, which is the claims experience for each year, totaling $9,000. And the 3 years average performance premium, well, we're going to say it's $50,000, totaling of $150,000. So the next part is to consider an employer's performance, Craig, compared to the scheme. So what is the employer's performance based on?
The employer's performance is based on those cost of claims above their APP for those 3 years. So the 3 years worth of cost of claims above the 3 years of APP as a percentage.
Okay, and in the example here, which we've just brought up on the slide, we take those 3 years. So when we say 3 years, if your policy is due 30 June 2023, which is in a couple of weeks' time, we'll go back to 30 June 2020 and just include any claims where there has been a time lost or wages paid on a claim. Anything prior to that gets excluded. It drops off as we move forward here. So I've already mentioned how we've got the 3 years claims there, total of 9,000. We divide that into the total average performance premiums for those 3 years, 150,000, and as a percentage, that's 6%. Now, when we compare that to the scheme performance measure, which is set at 4.3% for the current year, so the individual employer's performance is compared to the overall scheme performance, and so that's basically the 6 over the 4.3. So this employer is running at around 139.5%. When compared to the scheme. So what we're saying is that because they're above 100%, they're performing, slightly worse than the scheme. So what happens next, Craig? We know in the example, the employer's performance is, is a little bit worse than scheme, but what does this actually mean?
So we have what we call the claims performance adjustment table, the CPA table, and then we look at that percentage. So we had 139.5%. And based on your APP, there's a category that you sit into. So if you look at that slide there, the top red circle, 30,000 to 50,000, is that employer's APP. Down the left-hand side, the claims performance rate is that percentage that we had, which was 139.5, which is in the bracket there, 130 up to 140. And then we get an adjustment factor there circled in green, which is 1.075. So as a result of that second calculation, we multiply this employer's APP of 50,000 by 1.075, which gives us the answer of 53,750. So it's 3,750 above their base premium because they're actually had claims and they're performing slightly worse than the scheme performance measure.
And I suppose you see that blue line in the middle there, which is based on 1. If their performance was under that blue line, they'd be performing better than scheme and probably be getting a discount.
And get that discount. So those factors there, you can see the top one at 0 to 10% is at that smaller end of the scale is 0.975. You multiply that by the APP and that'll reduce the 50,000 down by that amount. Yep.
Now, I'll just say we try to keep this as simple as possible for the purpose of the webinar, Craig, but if any employers out there had any questions, they want to go through their specific premium example, because you have your own claims costs and your own premium costs, which would be a lot different to what we're looking at here. We encourage you to give us a call, have a chat to your underwriter, and just go through that premium notice with the underwriter so you can understand exactly how that works. But the next part, Craig, we're going to get to is around which factors actually impact, which claims factors actually impact on the premium. And I'm just going to look at the left-hand side to start with there, which is the non-premium impacting costs, because it's important to know these. So these are costs that are excluded from the premium, and this includes the future claims cost estimates, investigation costs, legal costs, medical expenses. And medical expenses can be quite a large cost on any claim. Interpreter and transportation and accommodation costs for those that need to travel to receive treatment, and then rehabilitation costs, costs associated with engaging rehabilitation provider. So we'll look at the costs which are included, because these are really important, and these are the weekly compensation payments or the wages that are paid to workers whilst they're not working, whilst they're unfit, or maybe whilst there's some suitable duties available in the workplace, but the worker is fit to work, but there's no suitable duties available in the workplace, is what I meant to say. So they're basically off work, still receiving a wage, and they could be back at work, meeting those duties. And there's also some other charges around commutations and lump sums and common law type of charges, which can be quite large, but generally come on in the later stages of a claim. And sometimes it's outside the premium sort of scale. Now, listen, just before we move forward, I want to talk about, there's an incentive, Craig, called the return to work incentive, which is something that encourages and supports return to work. So for any time loss claim, if we can get the worker back within the first 13 weeks of the claim, the employer could be entitled to a 15% discount on that individual claim with regards to their premium impact. If it takes a little bit longer, 13 to 26 weeks, well, it'll be 10% that they're entitled to with the return to work incentive. If it takes a little bit longer again, 26 weeks up to a year, 52 weeks, the employer would be entitled to 5% discount off that claim cost. But it's really important that the worker needs to sustain return to work for a period of up to 3 months for that claim, for the discount entitlement to come through. So look, not only does getting your worker back to work quicker and providing suitable duties or light duties support a speedier recovery, it can save you money in your premium as well. I just want to quickly mention, along with any direct financial impact from your premium, there may be a number of other indirect costs as a result of a claim. And this could be the loss of productivity, having a staff member away from work on a claim, time, resources, and effort to backfill a position, and perhaps impacts on other staff who may have to pick up a little bit more work whilst one of their colleagues is off work as well. Now, before we move forward, Craig, I want to ask you about premium protection that may be in place to prevent any escalating unaffordable increases, because sometimes accidents happen due to the most unfortunate circumstances. Is there anything in place to protect employers?
Yeah, there's a capping of 30% maximum increase from 1 year to the next of the premium payable rate based on your own claims performance. So if your claims have caused your premiums were increased from 1 year to the next, that impact of that claims adjustment is limited to a 30% ceiling or cap. And that's set by CIRA in their market premium practice guidelines. So we have to do that. And we're happy to do that. That's part of the premium calculation. So it doesn't automatically jump up more than 30%. Yeah. So it limits the increase from 1 year to the next, purely as a result of your own claims experience adjustment. So if your wages were to go up by 200% and there's nothing changed in your claims, that's not a cap. There's no cap there. And if the WIC rate changes, that doesn't continue or take part of the capping. It's purely as a result of your own claims experience adjustment. So it's only for experience adjusted employers.
Sorry, I may have jumped on mute there somehow. Yeah, that's right. It's great to have that bit of protection there in place. But let's talk about grouping now. I know a lot of employers who have joined us today are part of a group.
Yep.
Can you explain what this means?
Yeah, grouping was introduced a long time ago now. So it's for those employers that are related or grouped for under the definition, and it's the same, pretty much the same definition as there is for payroll tax. Your premiums are assessed as a group. So we assess your APP as a combined amount. So when we had the table previously there, the CPA table, and we had the 30,000 to 50,000 and 50,000 to 100,000, we add all your APPs together to see where you fall into what category or what. And there's 8 categories across the top to 2 million plus. And you're assessed as a group to where you fall in the table, but then your premiums are assessed separately under that using your own claims experience.
So does that mean a claim on one policy in a group will impact another group member?
No. Your own claims in your policy are in your premium calculation, but your banding where you fall into the CPA table is based on you as a group size. Yeah.
Oh, okay. So if it's a larger group, when you go to that table we had on the screen a moment ago, you might be in a different column in terms of the banding.
Yeah, your own individual APP may be 50,000, but if the group APP is 500,000, you will fall into category 5 or 6, wherever it is.
Okay.
And then that way the adjustments factors change. Yeah.
So a claim on, say, policy A or policy B won't impact policy C, D, and E as part of a group. Oh, that's good to know. So let's move on. We've received a number of questions actually about the renewal and wage declaration process via the registration. Some people experience a few difficulties in how to do that, or what is the best approach. So can you run us through the policy renewal process and what to do? Because 30 June's coming up. It's a key important time of year.
Yeah, there's a high percentage of our policies are on 30 June renewals because it's just easier for employers to do everything as at 30 June, or your tax requirements and reporting requirements and your OSR reporting requirements. So a lot of policies are aligned to 30 June. So we attempt, for experience adjusted, we try and issue your renewal documents as soon as possible after 30 June, telling you what sort of estimate of wages we're going to use, and giving you all the details of what your premium will be for the next 12 months. And we only use the claims costs that are there for the previous 3 years as at that date, as at 30 June 2023. Those same claims costs will be used when we do an actual adjustment based on your actual wages. So we give you all that. If that estimate's not right, you might have had an increase in turnover, you think you're expanding and your wages are going to increase from, say, $2 million to $4 million, you have the opportunity to either tell us or go into our online portal and increase that estimate of wages to adjust your premium accordingly. So there's no shock at the end of the policy period when we renewed on an estimate of 2 million, your actuals were 4 million. So you can change that through the portal, but the most important thing, or the other important thing, is that for the period that's just finished, you've got from the end of June to the end of October to tell us what your actual wages were. So we can make the necessary adjustments to the year that's just finished. So if your estimated wages were higher than your actual wages, we adjust your premium accordingly. And we use those figures to work out what figures we should use to do your next renewal. So it's important that not only you check your estimates to make sure it's an accurate reflection, and it doesn't, obviously it's by the term, estimate is just that, it's an estimate, but make sure that it's somewhere near the vicinity of what you think your estimated wages will be. And if it changes in another 3 months or 4 months, you can let us know, or you can go into the portal and make that adjustment. But the most important thing is to, at the end of the policy period, let us know what your actual was, so you're paying exactly the premium you should pay, no more and no less on the basis of that.
And you referenced that portal a couple of times, and you can do your declaration a couple of ways, online or the old-fashioned way, the paper-based, and that's okay. It just may take a little longer to get your adjusted premium through if you go the paper-based. Look, sometimes when you do your adjustment online, you might get a message, it hasn't quite gone through. Just give the underwriters a call on 134422, because that'll help you in determining the correct premium that will be payable as well. And look, the last point I want to make is around employers that may have received a credit. There seems to be a point of confusion, Craig, when they get a credit process through and what that means. So if there is an upcoming premium due and payable, the credits will be offset against that, and it could be an instalment. If nothing is due, the employer will receive a refund within a few days by EFT or by check if we don't have their EFT details. But I just want to actually add something now, a bit of an update, is that from the end of the year, we're going to no longer be issuing refunds via check. It's going to be 100% by EFT. This will allow a quicker and a more seamless process with regards to sending refunds to employers. So make sure you've provided us with your bank details so we can process any credits when they're due. All right, let's move on, Craig, to something else that is new come 30 June. That is the Safe Employer Reward, which is a new incentive, and I'll just bring up a slide for you to help explain it. What is the Safe Employer Reward, mate?
It's coming in now to replace what we've had, which was the Employer Safety Incentive, which was an automatic reduction in premium that was given to every employer that when we introduced back in 2013, was with the expectation that employers would use that money, or that money that was taken or given back, to train staff or buy equipment or to make their workplaces safer. Now it's been a number of years since then. We're now moving to a performance-based system. So there's been nearly 10 years where we've allowed that refund or that discount to be paid and to be used to make your workplaces safer. We're now looking to see people actually performing to get that reward or that reduction. So if you're performing better than the scheme performance, and so you're on that table that we had there before, you're less than 100%, so you're 80 or 90 to 100 or 0 to 10 or 30 to 40, you'll get a reduction under the Safe Employer Reward that's reflective of those percentages that we had there. So if you're between 0 to 20, you'll still keep the 7.5%. If you're 20 to 50, you'll get 5%, and if you're 50 to 100, you'll get 2.5% as a reduction.
Okay, well, that's a great new incentive that's coming through, and hopefully many employers, I think quite the vast majority of experience rated employers, based on the current experience, would be entitled to that discount as well, which is great, fantastic. All right, let's get onto a more complicated topic, and it's one we like to cover. And that is determining if someone is a true contractor or perhaps could be a deemed worker for the purposes of New South Wales Workers' Compensation. What that means is that some contractors may be covered under the policy, even if they have an ABN number. This also means that an employer will need to declare the payments to those workers on their policy. Now, it's not always black and white, Craig. Are you able to explain when a subcontractor may be a deemed worker and the difference between a true contractor and a deemed worker, and if there are any straightforward rules that could apply?
Yeah, it's the deemed provisions are in the legislation, that they're there to deem certain types of workers or employment arrangements for those people to be workers rather than contractors. So the general rules is that a worker is normally directed by the employer. So you'll say they have to be there Monday to Friday. They have to work from start at 7 and they have to finish at 3:30. They will. The employer will provide all the materials. The worker will just come on and sometimes not even bring tools, just come on and just work solely for that employer. They're paid on a time basis and they work exclusively or normally exclusively that single employer, and they may even be subject to PAYG tax arrangements. Contractors tend to be demonstrating that they're running a business of their own and working separate to the employer. So they would normally quote or tender for a job. So you might say, I need you to do this work. How much is it going to cost me? As opposed to, I want you to do this work and I'm going to pay you an hourly rate. So the contractor will come in and assess the job. They have the ability to make a profit and loss over and above what they charge. They have other people working for them as well to do the job. It's based on their quote. That's what the price will be. They bring their own materials, their own goods and tools, and they're more than likely, in most instances, carrying on a business in their own right. They're advertising their services to not just that one employer, but to a number of employers. They're in the local newspapers. They have, all those sorts of things going on. So they're actually running a business. Just having an ABN and just working for you, and they only work for you, would normally still mean someone's a deemed worker rather than a contractor. But a contractor has more control over what they do, when they do it, how much they charge for it, whether they make a profit or a loss, etc. And that they'd be more likely a contractor.
Yeah, and we've got those control tests there on the screen, but there's something else which I'm going to refer to, which I haven't yet. That's the wages definition manual, Craig, which is something that we're going to send out to everyone who registered for the session. You'll get a link to the wages definition manual, which will help you not only with your wage declarations, what to include, what to exclude, but also covers off in a few other different categories like working directors, family trusts, but also contractors. There's good information in there about contractors to help you determine whether someone could be a true contractor or could be a deemed worker. But once again, we always encourage you to have a chat to your underwriter where possible, just to sort of flesh out some of these more difficult topics. Now, before we move on, Craig, before we finish, I just want to add that over the years, lots of employers have asked me whether and different ways to help reduce maybe claims or claims impacts on their premiums. So what I like to say is, we always encourage that you try to foster a safety culture in your workplace. In your work health and safety type meetings that most businesses would have, don't just include managers and supervisors. Get the staff that are on the ground doing the job and ask them what tasks, what's making your job difficult to help identify any risks. And then, of course, if you have an injury, report the claim as soon as possible. Allows for injury management and return to work processes to begin and planning. But also shows support for the worker who may be injured and maybe off work, feeling a little bit anxious, maybe a little bit judged or guilty sitting at home in a little bit of pain as well. So stay connected with that worker. If they're away from the workplace, we always encourage you to keep your worker included, keep regular contact up and keep them included in any workplace type of activity or perhaps social activity. And look, the other thing before we move on to the Q&A, Craig, is so many employers over the years are not sure whether to report a claim or not. Look, it's really important that you report a claim as soon as you possibly can. It's legislated. You have to report claims, when there is time off or paid medical treatment, sought after. And by not reporting a claim, not only is it against the legislation, the worker may not get the medical attention they need as soon as possible. The injury could get worse. They could be out of pocket and have to pay for their expenses and maybe use their own leave entitlements when they shouldn't as well, which can result in a relationship breakdown overall. So report claims, it'll generally get you a better outcome than not with regards to, not only return to work, supporting the worker and recovery, but also getting your premiums. So what we're going to do now, Craig, is that brings us to the end of the formal part of the presentation. I'm just going to get Madeline to turn the chat back on now. Just give her a second to do that and open up the poll. Now, what we want to do, we just want to, before we move on to the Q&A, quickly we want to get what you thought of the session with a quick poll between 1 and 5. I'll just explain the poll. If you thought the session was okay and you got something out of it, you'd give it a 4 or 5. If it was just so, you'd probably give it a 3. If you didn't like it, it was a waste of time so far, then you'd give it a 1 or a 2. So we'll just quickly do the poll. And if you can put any comments about the session in the chat now and start answering, asking your questions, which we'll get to answer in a moment. I can see people putting their scores in the chat, but just put it in the poll that should have popped up in the middle of the screen or the side of the screen there. I can see most people have that. So also on the screen, you can see for any brokers, that's where you get your CPD points. And if there's a QR code where you can scan where the mobile engagement team, which I represent, where we're going in the upcoming months. And actually next week, this time next week or tomorrow week, we'll be in Dubbo running a mental health forum. All right, so we're giving people a little bit of time there to put in their comments and questions, Craig, and ratings. We will share the recording. It will be made available on our webpage. Let's have a look at some of these questions that have come through here. I'm just going to scroll back to the top because we've got lots of great questions coming in. Recruiters. What's this one here, Craig? The first question I got is a WIC code that needs to be used for recruiters. When employers are recruiters, employees, they go for a client. Is that labour hire, you think?
So, well, there is labour hire, but there's also a recruitment rate or a week for people that are working,
agency,
so they don't
yes.
pay the workers, but you might go to them and they seek out, you say, I need, I don't know what specific trade or occupation that you want someone, and they have their own week in there. So I'm not sure, but a bit more detail around that one may help. But there is a week there's a week for people that run labour hire or recruitment
Yes.
type activities, but they're not paying the workers. They source employees, send them to the employer takes them, pays them, and then they have that, which is a fairly low rate because they don't have direct employees that are doing any of that work. Yeah.
Yep. And here's a good one here. Actually, a topic we didn't broach in this webinar from Charmaine. Lots of questions coming in, but this one here says, if you have multiple branches around Australia, do you need a separate policy for each state?
Yes. If you have workers operating in each state, you need a policy for each jurisdiction. Yeah.
Okay. One about the question, will you share the recording? Yes, the recording will be available on our website. And then we've got this question here about the $30,000 limit. Hasn't increased? Well,
hasn't increased.
It's not for a while. Not for a while.
It hasn't been increased since 2015, but it's set by CIRA. It's the regulator. It's in their market premium practice guidelines, and the threshold is for 30,000. We have regular meetings and discussions with CIRA, so we look at it and we sort of make recommendations, but it's not always taken up. So it may change, but it hasn't been. There's no CPI increase to the 30,000. It's been 30,000 now for pretty much 8 years. Yeah.
8 years, a fair while. I know before that, because we've both been around a while, it was 10,000 there for some
time.
Used to be
10,000, and
when 3,000 before that.
Yeah, and when I first started, it was 2,000. So that's how long ago it was. Yeah.
There you go. The question here, is there any information available for employers who are interested in determining how to calculate the maximum premium cap? Not sure.
We'll have our premium forecasting tools on the website shortly, so you'll be able to go in there and put your details in there to see what your premium is, and it has the capping details built in it as well. But if you're having any trouble, just contact one of the underwriters on that number, 134422.
All right, and here's one here, which is a good question. What is classified as the catastrophic claim to determine the SER?
A catastrophic claim is a fatality claim, unfortunately. So that was introduced from 30 June 2018 for all employers. They no longer are premium impacting for a fatality claim, but the employer is required to pay a one-off contribution, which is, for large employers, it's 30% of your APP, so it's to a minimum of $1,000 and a maximum of $250,000. But it's a one-off payment, whereas before that fatality claim, which would full death, there are $800,000 plus claim. Your large claim limit's $150,000, so it's automatically, if it's paid, it's $150,000 impact for 3 years. So that's not there now for large and experienced adjusted employers. It's just a one-off payment of that. Yeah.
We'll keep moving down the list. I'm just going down the list as they come in, and they're sort of jumping about. So if I do miss one, I apologise. But here's a COVID question. I think I missed the COVID question a moment ago. It disappeared. Will COVID payments be included and used in the last 3 years?
COVID claims, so if you've had someone who's contracted COVID as a result of their work, they're not premium impacting, or if they've had a direct effect from receiving the vaccine for COVID, those claims are not premium impacting at all.
And a question about an NDIS support worker. There is a rate for support workers in the WIC rates. Off the top of my head, I couldn't tell you what that is, but there's definitely a rate for that type of activity, that type of industry. Yeah. When a contractor comes under someone's policy, their ICAP policy, should we identify them separately to the other employees?
You can, when you're making your declaration of wages, you can have direct wages that you're paying to employees, and there's a separate section for contractors where you can make a declaration for those contractor payments. Yeah.
Great. Someone asking about the labour hire WIC. I'll just answer that quickly. There is a WIC for labour hire, but all the staff that are lent out or hired out or contracted out go under the activity or the industry that those people are working in. So it can be a bit of administration in terms of capturing all the wages, ensuring it's in the right categories and the like. That's how we do treat a labour hire policy there. Anything you see, Craig, you want to jump on?
There was one
What are
there
they-
about fraud for RSI.
Okay.
If a claim is found to be fraudulent and successfully prosecuted for fraud, those costs will be removed. So if that's something that has been identified, they've been charged with fraud and prosecuted and it's been successful, those claims costs will be adjusted retrospectively. And sometimes it goes back a number of years because it does take a long time for a fraud matter to be investigated, prosecuted and successful.
Got one here, if you like,
Yep.
from Linda. So I think she's saying if someone has an ABN number and they have their own workers' comp policy in place, do you include them in your declaration?
If they have an ABN number and they have a workers' comp policy, it would indicate that they have their own employees. You just need to keep a record of those details. So in case you're audited at any stage, why you haven't included those payments to that person or that entity with an ABN. So it could be a sole trader that has an ABN that has 3 or 4 employees. That's why you haven't included those payments, and you've got details. You get a copy of their certificate of currency, and you can get what we call as a principal contractor statement under section 175B of the legislation that you've got their certificate of currency. They've guaranteed that the policy's in place. Yeah.
And the one below that actually is pretty similar. What if an employer doesn't declare the correct wages, Craig?
If you don't declare them in your actual and you're found under audit to have been underdeclared, we will. So if your policy is selected for audit, we'll make an adjustment to those wages based on what the audited wages are. And if the variation is significant, so the variation between what you declared as your actual wages, as opposed to what the auditor found, if it's greater than 25% variation, there is a facility to charge a late payment fee on that underpaid premium component.
And one here about where to report claims to CIRA or to iCare.
To iCare and your claim service provider. Yeah,
that's right. And your claim service provider could be a number of EML.
Yeah.
GIO, Allianz, there's a few there, QBE, there's a number of claim service providers in the scheme at the moment, or being reintroduced to the scheme at the moment. So now here we go. Here is the 3 years of claims that is used to measure. Are these claims only for loss of wage or medical expenses as well?
No, well, there was a slide there earlier that you put up, Huck. So when we use the cost of claims to work out the impact on your premium, there's no medical expenses included in that cost of claims. So that example where you had the $3,000 for 3 years, which was $9,000, in most instances it will only be weekly benefits. The other components that we do include is a commutation or a Section 66 payment, which is a payment for a lump sum impairment. Most of that stuff doesn't happen in that 3 years because it takes a while to work out what someone would get for Section 66. Their injury has to be stabilised. There has to be no further improvement. So most of those payments don't get paid in that 3-year period. If they do, they would be included. Generally, it's only weekly benefits that are used in the cost of claims to work out the impact on your premium. All those other medical expenses and rehab and etc. are excluded in what we use to work out your own performance.
Yes. And another one here about the wage declaration process. So if actual wages declared differs from the estimate substantially, is there a penalty?
Not in just your estimate and actual process. No.
That's right. A few more questions here around, like admin staff, and they've got electricians and the like. They use contractors, and they're looking at different industry rates. All we can say is we can't answer your specific structure and example now. We always encourage you to talk to the underwriter, have a chat through the structure of your policy, just to make sure it is rated correctly there. Questions here about overtime hours, superannuation. These are all included in your wage declaration. And again, we're going to send you an email with a link to the wage definition manual, which goes through all the different types of payments that you include and probably exclude when it comes to the wage declaration. Now, what else we got here? There's a question about excess. If a staff member who didn't report a claim for 2.5 months after the fact, due to their own choice, so a claim couldn't be lodged on time to avoid excesses, is there a way around that so the organisation isn't at fault? Just want to explain that one.
Well, it's when you become aware of the incident or the claim. You've got your 5 days to make the notification. So if they were injured and didn't tell you and didn't make a claim, it's the 5 days starts as from under the not having to pay the excess of when you were made aware of the injury in the incident.
Yeah, because sometimes they won't report the claim, like in that example for 2.5 months. It's now 2 months later. They injured themselves back in March. You've got 5 days from when they tell their supervisor or the manager or the owner of the business, someone senior within the business there. So, can you see anything else, Craig, that stands out you want to jump at? There's quite a few questions here.
Someone there said, if a claim goes for longer than 3 years, how long are my premiums affected? The claim, as you touched on it in the presentation, Dave, it only impacts for 3 years. So if you had it in this year that's just finished from 30 June 2022 to 30 June 2023, it doesn't impact the year that's just finished, but it impacts for the next 3 years. Mm-hmm. And then once it trips over 30 June, so that'll be 30 June 2026, it no longer, it falls off. So C1, C2, C3. So claims for the year that's just finished, C1, C2 the year before that, C3 the year before that.
Yeah, and questioning about sole traders, it's come up a couple of times. Why don't they get rid of sole traders completely, as they can go get their own workers' comp? I mean, if a sole trader has employees, they're an employer and they are required to take out a policy themselves there as well. What else we got here, Craig? About reporting a claim. If a tradesman gets a small cut, when do they need to report a claim? So I'll answer that if you like. If someone just has a small cut, for example, you do have to put this in your register of injuries book or some online form. And we're actually going to send you a copy of a document which you can use. That'll go in the email, which I've referred to a couple of times. If someone needs paid time off, so time away from work, or they need paid medical treatment, then you are required to report that claim. If it's just the example of a small laceration, nothing too great, you can report it as a notification only, just in case something happens in the future. But you're not required to unless there's paid medical treatment or time off from work. 1 minute to go, Craig. What have you got?
There's a lot there about the premium impacting claims cost, which was in one of your earlier slides, Dave. So I suppose we can make that available through the website.
Yes.
I think there is stuff on our website. It may not always be in the renewal documentation, but it hasn't changed since 2015. It's the same costs are premium impacting and the same that haven't changed since 2015. Except for COVID claims. We made that decision to exclude COVID claims.
Yeah. And the the return to work incentive and how that works. Once again, if you return someone to work within 13 weeks, I think it is, 15% discount between 13 and 26 weeks. It's 10%. Between 26 weeks and 52 weeks, it's 5%. But they need to sustain that return to work for a period of up to 3 months for you to be entitled to that discount on that individual claim. Craig, we're at time. So look, I've got lots of questions here, which is really great. We like to look at these questions because it helps us build content and responses for upcoming sessions that we may be delivering. But I just want to thank you and thank the audience again for being so interactive. Can people please just let us know your thoughts, what you thought of the session? Do you like these sessions? Do you want to see more of them? What are some future topics? I'll get you to pop that in the chat as we go off, Craig. But look, thanks again for joining me. On the screen there, you've got the upcoming events and the the broker CPD points. So I might just pop the music back on. It was a bit of hits from the 80s, I think. I had on there for everyone. I'll pop that on now while people just respond in the chat. And hopefully everyone has a good day and hopefully found that beneficial. Thanks again, Craig.
Thanks, Hux.
Talk to you soon. Right on, mate.
See you, mate. Bye.